This part is actually continuation of section 35A, B, 35D. We discussed about preliminary expenditures. Now let's continue with section 35DD. Because of some personal problems last week, I was not able to do any shooting, but I'm back with lot of energy and enthusiasm. So we'll continue. Now, section 35DD, what it actually talks about? It talks about expenditure in relation to amalgamation or demerger. So what I said, section 35DD talks about expenditure in relation to amalgamation or demerger. Now, basically what happens? The deduction under this section can be claimed only by an Indian company. So that means any other SSC, right, cannot claim the deduction. Only an Indian company can claim the deduction. How they can claim the deduction? If they incur expenditure in relation to amalgamation, right? So amalgamation related expenditure, it can claim deduction. Okay. So amalgamating company can claim deduction or amalgamated company can claim deduction. The answer is amalgamated company will claim the deduction. In how many installments deduction is given? In completely 5 installments over a period of 5 years. The deduction can be claimed. So the year in which the expenditure is incurred, from that year, how many installments? 5 installments for 5 years period, they can claim it as deduction. Right? This is how you should remember. Now, if you want to claim deduction under this section, that is under 35DD, then you cannot say that it is general expenditure and I'll claim deduction under section 37, right? So you cannot claim any deduction for this expenditure under any other section. So if you don't claim under any other section and want to claim under this section, then it's perfectly fine. Okay, so we discussed about section 35DD, deduction in relation to expenditure incurred for amalgamation. Who can claim? Indian company can claim. Which company? Amalgamated company should be Indian company, right? It should incur amalgamation related expenditure. No other section should give deduction for this. Then only in 5 installments over a period of 5 years you can claim the deduction. That's it. Now let's come to new section, that is 35DDA. Now this is basically deduction in respect of expenditure incurred for voluntary retirement scheme. Most often government companies do this. Like you would have heard about BSNL bringing it VRS scheme. Most of the government, like Air India bringing its VRS scheme. So VRS schemes are introduced mostly by government companies, sometimes by non-government also. Okay. But if you want to claim deduction for the expenditure incurred for VRS payments, who can claim? Obviously, all assessees can claim the deduction. So any employer who is doing expenditure on VRS can claim the deduction. When we talk about all assessees here, you should understand like this. Okay. Now let's continue. Now, for what this expenditure is there? VRS payment. Suppose an employee has to retire at the age of 60, but we want him to retire at the age of 58. So we'll give him some extra perks, extra money, and ask him to retire fast. Okay. Sometimes in our organization, manpower is more. So we'll ask our existing manpower to retire voluntarily, not forcing, not throwing them out. Right? So for that, whatever expenditure is there, that you can claim as deduction under this section. How many installments? In 5 equal installments you can claim. Over a period of 5 years you can claim this deduction. Okay, same like 35DD, 35DDA also 5 installments, 5 years. Okay, now if there is a case of amalgamation, then what will happen? Then the new entity, that is amalgamated company, will claim the deduction. new entity, that is amalgamated company, will claim the deduction. Sometimes what happens, succession happens. Like a private company is there, it is converted to a public company. So now the old entity will claim the deduction or new entity will claim? Obviously, new entity will claim the deduction. That means I said private company converted to public company. So public company will claim the deduction for a period of 5 years in 5 equal installments. Suppose sometimes what happens, unlisted public companies are there, private companies are there, they convert to a limited liability partnership. Then obviously LLP will claim the deduction. This way you should be able to understand. But suppose you claim deduction under 35DDA for voluntary retirement compensation paid to the employees, then you cannot claim the deduction for this expenditure under any other section. Like example, we are paying to employees. Let me claim deduction under section 37 also. Oh, the law is very clear. No double deduction. So you are claiming deduction here. That means you cannot claim deduction under any other section. Okay. Now there is a difference between 10 subsection 10C and 35DDA. This difference you should be able to understand. Now I have written 2 points for your reference, but I will discuss much more. First thing, 1010C talks about exemption to employees under the head salary chapter. 1010C talks about VRS exemption to employees under the salary chapter. Whereas when we talk about 35DDA, it talks about deduction to the employer under profits and gains of business and profession chapter. Okay. Now, for employer, there is no restriction. There is complete freedom. So, under 35DDA, employer may be anybody. It may be sole proprietor, partnership firm, company. He expended, he spent the money, he'll claim the deduction under 35DDA. Whereas, if employee want to claim exemption under 1010C, the rule is the employer should not be individual, should not be HUF, should not be partnership firm. So what they say that only a corporate employer should be there, then only, right, a government employer should be there, then only employee will be getting the exemption under 1010C. So for employee, there is a restriction, right? Employer should be corporate, then only employee gets the exemption benefit. Whereas under 35DDA, there is no such rule. For employer, he can be sole proprietor, partnership firm, company, HUF. You are a business entity, you paid money for employees, voluntary retirement, you claim deduction. That's it. Under 1010C, if employee want to get the benefit of exemption, the VRS should be approved by the board, approved by the Central Board of Direct Taxes. If it is approved by the board, then only under VRS you can claim the exemption. We are talking about employee claiming the exemption. It is approved by the board, then only employee can claim deduction. Otherwise, employee will not get the deduction. So for employee getting the exemption, there are a lot of restrictions you see. What are that restrictions? Employer should be obviously corporate. Individual HUF firm employer cannot be there, right? Then obviously it should be approved by the board. Such type of restrictions are there to get the benefit under 1010C for the employee. Whereas under 35DDA, no such restriction. Employer can be any SSC. He can claim the deduction once he made the payment, once he incurred the expenditure, right? And that too, his expenditure need not be approved by the board. So there is no restriction that the board should approve, right? all such restrictions are not there. So this is how they explain the entire concept. Now, so clear to all of you? Very good. Now let's come to section 35E. Very least discussed topic, but yes, it is there in the syllabus, so we'll discuss. So here this section talks about minerals basically, right? Minerals, mines, this section talks about. Now obviously you would have heard about Adani. He actually purchases lot of mines in different countries like Australia, Singapore, to extract coal, extract different minerals. Yes or no? So for Adani this section will apply. Okay. But as per the applicability conditions under section 35E, you can be an Indian company or a resident non-corporate assessee. If you want to claim deduction under this section, that is 35E, then you can be either an Indian company or a resident non-corporate assessee. Then you must be engaged in prospecting, extracting, producing minerals. What I said? Prospecting, extracting, producing minerals. Right? So if you are in the business of prospecting, extracting, producing minerals, or you are actually developing the deposits of minerals, then definitely for that expenditure you will get the deduction under section 35E. Now for which period related expenditure they are talking about? The year in which you started the commercial production, that year's related expenditure. And second one is 4 years prior to that. So the year in which, suppose 2024-25, you started commercial production. So expenditure in relation to 24-25 you can claim deduction. And not only that, but 2023-24, 22-23, 21-22, 2021. So 2021, 21-22, 22-23, 23-24. 4 years prior to 2024-25. So the year in which the commercial production started, and second is 4 years immediately prior to it. For this period, whatever expenditure incurred for production, procurement, right, or for extraction of the minerals, or for the development of the deposits of minerals, mines, you can claim the deduction under section 35E. But the expenditure what you want to claim as deduction should not be for acquisition of the site. Like example, a mine is there at a particular location. You were able to identify. Now you have to acquire that place. Na? That acquisition related expenditure. In simple language, purchase of land related expenditure. Okay. So acquisition of site or any rights in that site. Similarly, acquisition of the deposits of minerals, acquisition of deposit of minerals, or any rights in relation to that. For that, any expenditure incurred, you cannot claim the deduction. Basically, whatever commercial production activity is there, for that you will get the deduction. Only if you acquire the site or the deposit of minerals, you will not get the deduction. Okay. Suppose there are certain assets like building is there, like we can say furniture is there, plant and machinery is there. For that, you claim deduction under section 32. You will get the depreciation under 32. Yes or no? Yes. So for building, like plant and machinery, for furniture, you get depreciation under section 32. So already you are getting deduction there now. So no deduction under section 35E section. So under section 35E, you will not get deduction. So what I said, under section 35E, you will not get deduction for acquisition of a site or any rights therein, acquisition of a deposit of minerals or any rights therein, for purchase or acquisition of any depreciable assets like building plant and machinery, furniture. For this, you will not get deduction. Sometimes what happens, to support the businesses, government pays some money. So government incurs some expenditure, or some government authority may incur some expenditure, or any person may incur such expenditure. So if you are the assessee, you want to claim deduction, you should incur the expenditure, then you will get the deduction. If some other person incurs the expenditure, some other authority incurs the expenditure, then you will not get the deduction. Okay. Sometimes what happens, you have to sell some assets, or you sold some scrap, so you got some salvage value, or some asset is destroyed, you got insurance claim. For getting this income, you may incur some expenditure. Now you want to show that expenditure here and claim the deduction. The law says no. If it is in relation to sale of an asset, earning some salvage value related income, or some insurance compensation related income, if any expenditure is incurred, not deductible under this section. You deduct that expenditure, not here. Okay, you deduct under section 37, right? So like that you can do, but you cannot claim deduction here. Okay, let's continue with the discussion. Now, if suppose you are a corporate assessee, if you are a company assessee, then obviously you will have an audit, right? As per the Companies Act, you will submit the audit report. But what about non-corporate assessee? For them, audit is not compulsory. So under this section, the audit is made compulsory. So if they really want to get the deduction under 35E, then for them, audit has to be done. Who should do? A chartered accountant should do. And then submit the report under form 3AE. Which form? 3AE. Sir, should the form be submitted on paper or electronically? Silly question in today's times, correct? Obviously, forms should be submitted to Income Tax Department through electronic mode only. So, through form 3AE, you should submit electronically. Who should submit? Chartered accountant should submit. When he should submit? The answer is he should submit at least 1 month before the due date of filing returns. Now suppose, because audit is done, your returns have to be filed by 31st October, right? In that case, you should submit this report by 30th September. Suppose you are anyhow not an audit assessee, so 31st July you should file the returns. Then this report under 3AE should be submitted by chartered accountant by 30th June. So whatever income tax returns due date comes, at least 1 month before, this report should be submitted by the chartered accountant. Okay, this rule is clear. Now, what they wanted to tell that, okay, we discussed that the year of commencement of commercial production, I said 2024-25, and immediately 4 years before. So I said 2020, 21, 21, 22, 22, 23, 23, 24. For this period, you will get the deduction. But when will you get the deduction? You will get deduction in 10 equal installments. Right? All these 4 plus 1, 5 years expenditure is total, then divided by 10, and you will get the deduction in 10 equal installments. From when you will get the deduction? The year in which the commercial production started. So the year in which you started the commercial production, from that year you start getting the deduction under 35E section. But sir, sometimes income is less and deduction is more. under 35E, what to do? Suppose income is suppose 80 lakhs and the deduction is 1 crore 20 lakhs. What to do? So income is 80 lakhs, correct? Then you show expenditure also 80 lakhs and make your income 0. Now how much deduction is left? 40 lakhs, correct? I said your expenditure is, your deduction for this year is 1 crore 20 lakhs. So 40 lakhs left. This 40 lakhs you add to the next year, no? And claim deduction. We call these 40 lakhs as unabsorbed deduction. Right? The income is not able to absorb. The income is not able to adjust this loss, this expenditure, right? Cover it. So we call it as unabsorbed deduction. So it can be adjusted in the next year, maybe in the next year. But till how many years, sir? Till 10 years. That means if any unabsorbed deduction is there in the 10th year, you should be able to cover it. Sir, suppose unabsorbed deduction after 10 years also we are not able to claim. Still some amount is there in the balance. What to do? Then you cannot do. You have to ignore that part. You cannot claim the deduction. So under section 35AE, section 35E, only 35E. Okay, what you are supposed to do? Claim the deduction in the first 10 years itself. Whether it is current year related deduction or the previous unabsorbed balance of deduction. Within 10 years only, you should be able to claim. Within 10 years from what? From the start of commercial production. You claim it. Otherwise, forget. Okay? Like this, you should be able to understand the topic. Okay. But suppose you claim deduction under this section, you cannot claim deduction under any other section. Right? And if amalgamation happens in between, demerger happens in between, then the new entity, like in case of amalgamation, the amalgamated company can claim the deduction as if nothing happened. Suppose the earlier company took the deduction for 4 years and after 4th year, amalgamation happened. So from 5th year onwards till the 10th year, the new entity, that is amalgamated entity, will claim the deduction. Suppose what happened? Demerger happened. In case of demerger, the resulting company will claim the deduction for balance period, right? It cannot happen that the earlier company claimed deduction for 4 years and the new company will claim it for further 10 years. No, both together 10 years, right? Whatever deduction claimed by the earlier company, it is okay. And balance period only the new company can get, right? I said 10 years total period given to you for claiming deduction. 4 years the earlier company took. How many years left? 6 years left. Only that 6 years the new company can claim deduction. So this is all about section 35E section. You remember? Sure. I'll ask you 2-3 questions. You tell me. Which SSE can claim the deduction under this section? Obviously, Indian company can claim, resident, non-corporate assessee can claim the deduction under this section. For what type of expenditure? Prospecting, extracting, production of minerals, deposit of minerals, mines, for that they can claim the deduction. For which period the expenditure can be incurred so that you can claim deduction? For the current year of commercial production, that is first year of commercial production, and earlier 4 years. For our exams, 2024-25 and 4 years means 2020-21, 21-22, 22-23, 23-24. Okay, for this 4 plus 1, you remember. If it is acquisition of site, acquisition of deposit of minerals or any rights therein, no deduction. Anyhow, for building plant and machinery furniture, you claim depreciation under section 32, no deduction here. Any expenditure incurred by persons or other authority, for that also no deduction. In relation to insurance claim, salvage or sale, if any expenditure is incurred, for that also you cannot claim a deduction for such expenditure relating to that. And if it is a corporate assessee, audit is anyhow mandatory. For non-corporate assessee, audit under this section required. What is this section? 35E. When the audit report should be submitted? 1 month before filing returns. In which form? 3AE. Who should submit? Chartered accountant should submit. How much deduction? Entire 4 plus 1 years expenditure for prospecting, extracting or production of mineral oils. Total the expenditure, claim deduction in 10 equal installments. If income is insufficient, treat it as unabsorbed balance and claim it in the next year, but not beyond 10 years. In case of amalgamation, balance period of deduction can be claimed by amalgamated company. In case of demerger, the resulting company can claim deduction for the balance period. Once you claim deduction under 35E, no deduction under any other section. If you remember this, that's enough. We'll discuss next section 36, and so many things are there. Yeah, focus. We will do it. We'll do the best possible. We are going to get the great results, right? But focus is required. पूरा commitment से पढ़ाई करेंगे, definitely result is yours. Okay, bye everybody.